I don't have a price level for gold, but I do tell people this, that if you put, for example, 20% of your savings in gold and 80% maybe lying in stocks. Of course, prior to this 80-20 split, you keep aside some money under your mattress or in SBI or with HDFC as a fixed deposit. You keep some money aside with you, and that money covers your 6 months, 12 months, 18 months, 24 months monthly expenditures. So you keep that money very, very safe. And then with the rest is 80-20, 80 equity and this thing 20 gold. If you buy gold, you should buy gold with a view that the day after you buy it, it will collapse by 50%.
Okay.
So today if gold is trading at $1,400 per ounce, buy it and pray hard to God that tomorrow it collapses down to half. Because if gold collapses to half, it means the world's problems have been solved and your equity prices will go through the roof. So your 80 rupees lying in equity will go to 160 and your 20 lying in gold will go to 10. Or your 80 lying in equity and real estate, whatever else, will go to 160 and be worth 160. Right? It'll really be a fundamental change in that sense. But if you buy gold today at 1,400 and the central banks of the large countries like the US and the Eurozone don't get their act together and they can't resolve the fundamental problems in those economies, then you've got a situation where the gold price could double or treble from where you are today and equities could halve. So the Indian stock market could halve because of a crisis overseas. Your 80 could become 40, but your gold, your 20 could become 40, 50, 60. So at the end of the day, you'll have close to 100. And that 100 will make you richer compared to all the peers around you. Because most people will not have the gold that will have gone up 2 times or 3 times. They'll only have the equity and they'll be a lot poorer than you. So I think as a measure of your buying power, it makes sense for you to have this pool of money kept aside, 6 months, 12 months, 18 months, 24 months of expenses, whatever your risk-taking ability is or is not, and then the rest should be an 80-20 split. But, again, going back to Bill's specific comment on can gold reach $3,000, it can. I mean, at $450 an ounce, no one thought gold would cross 1,000, and it did that more than double. Where again at 1,400, can it a little more than double to 3,000? Yes, it can. No reason why it cannot. Given where we are today, it can.
And how should one hold gold? This physical gold, there are gold coins.
Physical coins, and then of course you've got gold ETFs also, and quantum gold, I'll make a plug here again, quantum gold has an ETF. But you can hold it in whatever form you want. It's more convenient for you from a home basis to have it in a bar or a coin at home. But there is to that. There may be a theft in the house, something may break through, and also the cost of buying the physical coins are more expensive than buying a gold ETF. So, I mean, but if you buy a gold ETF, the gold is not with you in your hand. The gold ETF company, the fund, keeps it in a locker, right? In our case, it's lying in a locker, and every month, the fund manager, Chirag Shah, goes and tallies the gold bars, the numbers, serial number, with the list that he made the previous month, etc., etc. So but it's not in you can't see it, right? But of course, if you have the physical gold or the coin gold, you can see it or keep it in your bank locker and you can go to your bank and get it whenever you want. But I think as long as you buy gold, that's important. Buying a gold ETF is more efficient. Buying physical gold and jewelry gold and coin gold is still good. You're buying gold, but it's a little more expensive and gives you the extra headache of storage and theft and everything else that goes with it.
Is there a chance that if you put money in an ETF, there is no corresponding gold to it? Is there a risk at all, or there are enough regulatory checks in place?
No, there are. I think SEBI, the first time I went to the locker about a year and a half ago, I actually, asked the fund manager a bunch of questions around this, and we started the dialogue, writing with the fund houses and with SEBI on how do we make sure that the gold there is indeed gold. It's the right fineness. It's the right weight. It exists. So SEBI has now come out with a statement, I think a few weeks ago, asking for certificates or a note from the auditor of the fund that yes, that gold is lying there. But we do that on our own anyway, and the custodian sends us a report that it exists. But now there's a SEBI mandated thing also. But again, you've got to be careful. There are a couple of gold ETFs outside India, some of which don't buy gold. They speculate in gold.
Okay.
So if a gold if a gold ETF has got 100 rupees in it, it's got to buy 99 rupees worth of gold, because 1 rupee may be your expense for the year or whatever. But if a gold ETF in India has got 100 rupees in it and it has 110 worth of gold, then how do you get the other 10?
Yeah.
It has to borrow or something. So you got to be a bit sort of careful about that. But I think by and large, if you do a bit of homework, you will get. I will say this for the quantum gold ETF, that we do not borrow. There's no leverage. You know, every unit that you have is effectively backed by gold in a bar, minus that 1% per annum annual expenditures that we have to have, which has to be near cash.
And then, of course, gold versus silver.
Yeah. Silver is, like I said at the start, half copper, half gold. Silver is not a pure precious metal. It is not a pure industrial activity metal. If you want to buy industrial activity, then copper is a great proxy. If you want to buy pure precious metal, gold is a great proxy. Silver acts as what Chirag has written in one of his golden truths, that it's a 50-50. It's half of the both. And it moves like that. Now, there's been this sudden surge in silver since August 2010, where silver was about $18 and change, $19, and suddenly has zoomed to $30, all in the course of like literally 4 months. Now, there could be this notion that, oh, you know, if I buy for 10 grams of gold, I got to pay 22,000 rupees. But for 1 kilo of gold, I've got to pay 45 or whatever, 50,000 rupees. So, you know what, I may as well buy a kilo of, for 1 kilo of silver. So I may as well go and buy a kilo of silver. Well, you know, you can go and buy a kilo of rice. Don't buy 1 kilo of this thing, of the potatoes and onions. They're more expensive these days. But anyway, but you know, in theory, it's not, you can go and buy 1 kilo of cotton, 1 kilo of onion, 1 kilo of anything, but it's not the same. Gold is gold and silver is silver. So the price of silver, in my opinion, I still will still stand by this. For precious metal purposes, do not buy silver. For precious metal purposes, for safety, for insurance, you buy gold.
There's one reader who's written in that, and he's a retired person, that he's been told that in 3 years, silver will be 100,000 rupees a kilo. And should I be putting my money there?
You know, we don't know on what basis that statement is made. I really don't know.
I think it's a bull market. That's what it says.
Yeah. I mean, you look at the price of gold, price of silver, it's scary. There's something happening there, it's not real. What happened between August 2010 and December 2010, in these 4 months, that the price of silver has surged by some 50% in just a span of 3.5 months. There's nothing, you know, there's no massive economic boom.